Let's get right to it. Some of the steepest real estate price corrections in a decade have just hit 5 neighborhoods across British Columbia. For a buyer, a double-digit price drop looks like a rare opportunity. However, many of these markdowns function as structural traps, masking long-term liabilities that can quickly erode your equity. To identify the true value, we're pulling the latest 2026 data directly from the BC Real Estate Association, Greater Vancouver Realtors, and the Vancouver Island Real Estate Board to synthesize a clearer picture. The baseline data tells us that across Metro Vancouver, detached homes are broadly down 6.9%, but a granular look reveals localized pockets experiencing price collapses twice as deep as the regional average. In 2026, a discounted price only yields a return if it aligns with recent provincial policy shifts. A property that ignores these trends functions as a massive liability, regardless of the sticker price. That's why we are running these 5 neighborhoods through a specific evaluation framework, the ROI analysis. The first part of this equation is the input, the upfront percentage price drop you secure at the closing table, compared to peak 2024 valuations. The second part is the outcome. We weigh your potential for long-term equity growth against hidden deficit costs, items like incoming special levies, climate insurance premiums, or extended vacancy. Running every property through this strict framework is the only reliable way to separate a high-risk asset from a smart, generational buying opportunity. Let's start with Burnaby East, specifically the multifamily and high-rise condo segment. This bar chart compares Burnaby East against the broader Metro Vancouver average. While the wider region dropped 6.9%, Burnaby East's composite benchmark price fell 10.9% year-over-year by March 2026. On paper, the input looks highly attractive. You secure a modern, high-rise unit well below the pricing seen just 2 years ago. But the adjusted graph reveals the underlying cause. Active listings are rising sharply and intersecting with high vacancy rates. A surplus of investor-owned inventory is flooding the market as carrying costs drive current owners to exit. This supply imbalance limits your potential rental yield and future resale liquidity. Under our ROI framework, Burnaby East qualifies as a structural trap. Now, let's look at a different environment, North Surrey and Whalley. These areas are undergoing a physical transformation from residential streets into heavy infrastructure zones. The immediate equity savings here are substantial. Detached lots in this area are down 10 to 12% year-over-year. But unlike Burnaby, North Surrey has a massive catalyst actively supporting its real estate, the incoming Surrey-Langley SkyTrain extension. This diagram shows exactly why that matters. Under the new provincial small-scale multi-unit housing rules, traditional single-family lots near future transit stations are now legally mandated to allow up to 6 units. The initial discount offers entry, but the real value is the zoning density. If you can acquire one of these lots and hold it until the transit line completes in 2030, the ROI potential makes this a high-conviction buying opportunity. Moving up market, West Vancouver's luxury sector presents an environment where aesthetics mask a difficult financial reality for sellers. High-end estates that were listed for over $30 million in 2024 have recently sold at discounts of $5 to $8 million below their original asking prices. To an outsider, this looks like a rare chance to own trophy real estate at 2018-era valuations. This drop reflects a significant withdrawal of speculative capital from the Metro Vancouver market. These luxury corrections signal that the pool of high-net-worth buyers has drastically tightened over the last 24 months. Buying into this tier right now carries significant risk. A multi-million-dollar discount is irrelevant if the underlying demand pool required for a future exit has shrunk. That brings us to Richmond, specifically the 1980s and 1990s condo stock, which currently offers some of the lowest entry price points in the Lower Mainland. The double-digit price drops in these buildings make them highly tempting for buyers trying to break into the market. However, these buildings carry a massive hidden deficit. Many are holdovers from the leaky-condo era, facing decades of deferred maintenance on roofs, building envelopes, and elevators. As this financial gauge illustrates, initial savings are often negated by immediate costs. Over 100,000 BC condo owners are expected to face an average special levy of $8,000 per unit in 2026. Add to that the compounding costs of climate vulnerability. Properties in these floodplain-sensitive zones face soaring insurance premiums as flood events increase. Acquiring an older Richmond condo often means inheriting a massive unfunded liability that can instantly erase any equity gained at the time of purchase. Finally, we move across the water to Vancouver Island, focusing on the single-family and detached market in Nanaimo. The ownership market here is experiencing a moderate cooling, with single-family benchmark prices dropping too. But we have to contrast that slight dip in purchase prices with the current performance of the local rental market. This chart shows the anomaly. While ownership prices trend slightly down, the line for rental yields sharply rises. Rental rates in Nanaimo have increased by 3.8%, bucking the national trend of falling rents. While secondary markets like Richmond and Coquitlam are seeing double-digit drops in rental rates, Nanaimo's yield continues to climb. This divergence offers a rare cash flow advantage for island investors. Looking at this scorecard, the results of our ROI framework become very clear, separating the smart acquisitions from the traps. We have two explicit buying opportunities, North Surrey and Nanaimo. These locations win because they pair a lower entry price with ironclad market fundamentals, transit-backed zoning density, and strong rental yields. On the other side, we have three structural warnings: Burnaby East, West Vancouver, and Richmond. These areas fail our test because their initial discounts are swallowed by severe oversupply, capital flight, or catastrophic hidden infrastructure costs. In 2026, disciplined due diligence is the only shield standing between a generational bargain and financial ruin. Navigating this shifting British Columbia market requires objective data, a clear strategy, and extreme caution. To see exactly where your neighborhood stands, comment your specific postal code below, and we will send you a personalized price report. Thanks for watching.